Bitcoin just slid straight into 58,000 for the first time in nearly 2 years. And just when retail investors thought the bottom was locking in, a brand new structural trapdoor opened beneath the market. Most people are staring at price charts or panicking over the latest spot ETF outflows. They are watching the wrong thing, because sitting underneath the entire corporate trade is one specific asset ticker. Strategy's flagship preferred stock was strictly engineered to sit at a stable par value of $100. Today, it is cratering towards an all-time low. It feels like a minor corporate footnote, but it isn't. It is a mathematical warning light signaling that the largest single buyer of Bitcoin on planet Earth right now is running out of cheap fuel. Months ago, the mainstream financial media told you everything was fine. But after Kevin Warsh's first Fed meeting, he completely rewrote the cost of capital. He didn't even mention crypto once, but he changed the entire game for Michael Saylor. So right now, everyone is asking the exact same question. Is this the corporate flywheel breaking, or is this the ultimate liquidity shakeout before Bitcoin runs the hardest it ever has? The data genuinely cuts this both ways, and I'm going to show you exactly how to read it. By the end of this video, you're going to get the precise balance sheet runaway numbers, the two roads Strategy has left to travel, and the exact mechanism Wall Street is using to lock out retail from the market. To understand why the floor is cracking, you have to look at what just happened at the Federal Reserve. Kevin Warsh ran his very first Fed meeting as Fed chairman. He held the benchmark interest rate at a flat 3.5 to 3.75%. The mainstream financial media looked at the surface data and moved on, claiming the Fed did absolutely nothing. But underneath the surface, the committee executed a massive structural shift. They didn't change the current rate, they aggressively changed the future forecast. Back in March, the median policymaker projected that 2026 would end with rates at 3.4%. That represented a clear path towards liquidity indicating rate cuts. On Wednesday, that median projection shifted upward to 3.8%, a rate hike. 9 out of 18 federal officials now officially project rates to finish higher than where they sit today. To the average retail investor, that sounds like boring macroeconomic jargon. It isn't. Interest rates are the literal price of global money. And when you artificially raise the price of money, you completely rewrite how every single risk asset on earth is valued. Think about the math an institutional fund manager faces right now. When interest rates remain elevated, an investor can park tens of millions of dollars into perfectly safe US Treasury bills and yield a guaranteed 4 to 5% return with zero principal risk. The moment a risk-free asset pays 5%, every alternative asset is forced to compete against that alternative baseline yield. High growth tech stocks, bonds, and yes, even Bitcoin are suddenly measured up against the return of a government bond. Furthermore, assets that pay absolutely no native yield instantly become less attractive to big institutional allocators. Bitcoin pays no yield. You can already see this reality reflecting to the institutional inflows. The US dollar index pushed up near 100 into the Fed meeting, and the spot Bitcoin ETFs, which were the primary buyers driving the market up, instantly flipped into the biggest sellers. In a single week this June, we witnessed a staggering 3.4 billion in net ETF outflows, the largest single outflow event since these funds launched in 2024, following a brutal 10-session run of persistent selling near $3 billion. Because of this, Bitcoin is currently struggling in the low to mid $60,000 range. Now let's look at the fair counterpoint, because I'm not here to inject blind fear. A large portion of these ETF outflows is just simply profit taking. Major institutions bought their initial allocations in the low 50,000s during the first quarter. They are locking in gains, and total net ETF outflows since 2024 still stand strong near 58 billion. The long-term adoption story is entirely intact, but do not lose sight of the core mechanism. Kevin Warsh said nothing about crypto and nothing about Saylor. He simply moved the price of money, and the price of money sits underneath the one instrument almost nobody is watching. To see why this macro shift lands directly on Michael Saylor's balance sheet, you have to understand exactly how Strategy buys its Bitcoin. They aren't utilizing software revenue, they are utilizing raised capital. And the most critical pipeline for that raised capital is an instrument called STRC. It is a variable rate Series A perpetual preferred stock that Strategy launched back in July of 2025. At the time, Michael Saylor publicly hailed it as the company's iPhone moment. It was aggressively marketed to institutions as premium digital credit, a high-yield place to park corporate cash that was supposed to behave like a stable fixed income instrument while paying out an attractive 11 to 12% dividend. The capital flywheel operated through a very clean loop. Strategy sells brand new STRC shares into the market at a stable target price around $100 through an active at-the-market or ATM program. This program raises immediate cash. Strategy then takes that cash, buys spot Bitcoin, pays out the required dividends, and manages their existing corporate debt, as long as STRC trades at or above its $100 par value. Strategy can continuously issue new shares and continuously buy more Bitcoin. The entire corporate machine depends on selling STRC near its par of $100. But here's the crucial detail that the marketing material moves past very quickly. STRC is not backed by Bitcoin. According to Strategy's own official filings, this preferred stock is completely uncollateralized by the underlying Bitcoin holdings. STRC investors hold only a general claim on whatever corporate assets are left over in a worst case scenario liquidation event. It is not FDIC insured, and it is not a protected money market fund. Its price stability does not come from physical assets sitting in a vault. It comes entirely from a single corporate lever. Strategy manually resets the dividend payout every single month to steer the market price back toward the $100 par value anchor. As long as Wall Street believes an 11.5% dividend is enough yield to justify taking on the corporate risk, the stock price holds at $100. The share issuances continue, and the massive Bitcoin buying pressures stay active. This means the entire corporate machine has a single fragile point of failure. If STRC drops below par, Strategy is forced to pause its at-the-market issuance program. No share issuance means no fresh cash, which means zero new Bitcoin buying power flowing from the specific channel. That is the engine. So the ultimate question we face today is simple. What happens when the market completely stops holding the line at $100? This is exactly why STRC is acting as a massive warning signal for the broader Bitcoin market. It was engineered to remain stable at $100. Yet in its most recent session, it closed at $74. This isn't a single bad trading session. STRC has been trading under its $100 par value consistently since April 15th. This is a definite 2-month structural drift. Now look closely at what Strategy's board did on the way down, because they actively used their dividend lever to defend the stock. STRC originally launched with a 9% dividend yield back in August 2025. As macro pressures mounted, they raised the yield to 10%, then 10.25%, then 10.5%, then 10.75%, 11%, and then 11.25%. That is 7 consecutive dividend increases designed exclusively to protect the $100 aim. In March, they dialed the yield up to its current 11.5%, and they completely froze. Throughout April, May, and June, while the market price broke below $89 and slid toward $85 and $80, the dividend rate sat dead flat at 11.5%. Here's why the frozen rate is the real story, and the data comes directly from Strategy's own investor filings. In February, the company formally published a strict, rules-based framework detailing exactly how the board should set this variable dividend based on the stock's volume-weighted average price. The internal corporate rules state, and I quote, "Average prices below $95 recommend a dividend rate increase of 50 basis points or more." STRC has been trading significantly below $95 for months. Under Strategy's own corporate playbook, that dividend yield should have been aggressively pushed up to 12 or 12.5% to force the stock price back up to par. Yet it remains locked at 11.5%. Let's be highly precise here, because precision is the entire point of this channel. This internal framework is a corporate recommendation, not a legally binding trigger. The board retains complete structural control and can legally choose to hold the rate flat. So this is not a case of a company breaking an active legal contract. This is a case of a company that wrote its own defensive rules, looked at the current macroeconomic landscape, and made a conscious, tactical decision to disobey its own playbook. Why would they choose to do that? Because raising a dividend is not free. Every additional 50 basis points represents millions of dollars of physical cash flowing out of the corporate treasury forever on a rapidly growing stack of preferred shares. And behind the scenes, Strategy's cash runway is getting tighter. Last fall, corporate documents pointed to a solid cash reserve capable of covering roughly 2.5 years of forward dividend obligations. The official proxy statements released this spring show that runway has narrowed closer to 1.8 years. So instead of raising the expensive dividend rate, the executive team is frantically pulling alternative corporate levers. They officially shifted STRC to twice monthly dividend payouts to attract short-term yield time buyings. The CEO has publicly floated plans to top up the underlying cash reserves. And in late May, for the first time since 2022, Strategy executed the unthinkable. They officially sold 32 Bitcoin from their balance sheet, and explicitly sent cash proceeds directly to satisfy the STRC preferred dividend obligations. Now, to be completely fair, during a subsequent appearance on CNBC, the strategy CEO framed this asset sale purely as an operational test. He looked at the cameras and confidently stated, "We did not need to sell our Bitcoin to satisfy our corporate demands." Perhaps that's true, but the cold, hard reality remains the same. They executed the sale, and the physical cash went straight to covering the preferred dividend. However, because this channel is built on forensic precision and not blind sensationalism, we must look at the true bull case here, and I really want you to understand it deeply. Against this preferred shared liability, strategy still holds many times its total debt value in pure spot Bitcoin. Furthermore, their dividend obligations have been paid flawlessly, on time, for more than 20 straight monthly distributions. Top institutional macro analysts at Benchmark and TD Cowen have pushed back incredibly hard on any mainstream death spiral narratives. And even during the exact weekly window where the company liquidated those 32 Bitcoins, strategy remained a massive net buyer of the asset class globally, adding roughly 1,500 additional Bitcoins to their corporate vault through alternative financing structures. This is absolutely not a story of corporate insolvency, and I'm never going to pretend it is, but practicing forensic macro analysis means you listen to the objective price action of the credit markets, not the corporate press releases. And right now, institutional capital is actively voting with its dollars. Recall the two conflicting data points from the beginning of this video. The public tweet from Michael Saylor proclaiming absolute victory. Meanwhile, the preferred stock chart shows the cost of running the corporate machine that actually bought those coins just went up significantly. Here's the real macro alpha on Bitcoin. Using STRC as a leading sentiment indicator, a market price under $100 on STRC is the credit market explicitly stating that the implied risk of holding Bitcoin has risen to roughly 13%. When STRC pays an $11.5 annualized dividend at its $100 par value, it yields exactly 11.5%. But when the market drops that exact asset price down to $74, that static dividend suddenly yields far higher. You would be entirely correct to point out that the variance isn't about just Bitcoin itself. It is heavily influenced by corporate strategy, balance sheet management, and rising institutional competition. That is exactly why macroeconomic analysis is highly complex. And that's why I do this every single day for you guys to make these deep dive financial mechanics completely approachable and clear for your long-term planning. But make no mistake, this is mostly about Bitcoin. Strategy now has two distinct roads that they can travel from here to fix the machine. Option A, they can manually raise the STRC dividend yield towards 12% or 13% to aggressively drag the stock price back up to its $100 par value. That fix works instantly, but it structurally raises the long-term cost of every single future dollar the company tries to raise to buy more Bitcoin. Road B is that they can hold the line at 11.5% and allow STRC to sit deeply below par, which effectively throttles and pauses their at-the-market share issuance pipeline. Both corporate roads end up in the exact same mathematical destination. Significantly less buying pressure coming from the single largest institutional buyer in the world. That structural showdown isn't something you'll find in this week's surface-level ETF outflows headlines. It is the quiet underlying systemic risk to the immediate Bitcoin price. STRC is absolutely not a financial fraud, and the current holders are not going to be wiped out to zero. But the investors who bought into the asset at $100 are now down a full year of dividend returns on paper, holding a security whose price stability was always borrowed from the velocity of the next buyer. That is a critical liquidity mechanism you need to understand before you allocate your capital, not after. Kevin Warsh successfully moved the macroeconomic denominator. Keep your eyes locked firmly on the STRC chart, because that is where the entire corporate trade is telling you the absolute truth about global liquidity. And navigating these exact institutional truth bombs before Wall Street reprices the market is exactly what we focus on every single day inside our free community. If you enjoyed this video, you got value from it, like and subscribe. Peace.